Warren Buffett, he has $347 billion in cash. It's almost 30% of his portfolio. Prior to the sell-off in 2000 and 2002, he had about 20%. Before 2007 and 8 and 9, he had about 25%. So his cash position is the highest it's ever been as a percent of his portfolio.
The Financial Survival Network. Now more than ever. The Financial Survival Network.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. And with us today is Jim Welsh, MacroTides.com. And for you out there who are watching and listening, there's a link in the show notes that will give you Jim's latest August missive, and will be enlightening. Jim, I've gone through it, and it's a weird thing. If you don't like the numbers that the system's putting out, rather than changing the system, you just fire the person who's responsible for the numbers. Now, look, those numbers are useless. From month to month, they're kind of useless because they're always being revised up or down, and they're deceptive, right? The employment numbers are completely deceptive because if they wanted to, the government really wanted to give the true numbers, they've got the information in real time in terms of withholding taxes and taxes being paid from salaries. And then they could make adjustments for number of self-employed people and number of people in the so-called gig economy. Those people are supposed to be paying quarterly self-employment tax, so they can revamp this system to make it much more accurate, and yet they choose not to. What's your take on this?
Well, you're touching on all, key points. What they don't do, the BLS, Bureau of Labor Statistics, they haven't gotten to the 21st century yet, really, because the survey they send out to businesses is done by mail. And so the net result, Kerry, is they're surveying about 25% of all jobs, if you will, that are back in time for any given month. So they're only getting about 15% of the picture. So automatically you have a built-in problem where you're going to invite revisions as opposed to using technology and getting the information, all the information, very quickly. In addition, the birth-death model has been, I think, the biggest problem area. Back in 2000, the BLS said, you know what, we can't keep track of all the companies that are starting up and a lot of small companies that are disappearing. And so we're going to come up with an estimate of how many new companies are being formed each month, how many are going away. And in recent years, in 2015, I believe the number is the birth-death model created 28% of all the jobs. Last year, it was 49%. So you have this one input, Kerry, that I think is kind of, going crazy and creating a bunch of jobs that don't exist. So as the BLS gets subsequent surveys back in and quarterly information, they then revise the numbers down markedly, in addition to the monthly numbers that get revised. So you're 100% right. There are ways that the BLS can do this to make these data points more accurate, more timely, because the bottom line is when a number gets announced, we created 200,000 jobs or lost 200,000 jobs, financial markets move on that data point. 60 days later, 6 months later, they get revised. Oh no, it wasn't 200,000 plus or minus. It was only 84. So it's integral that they get this stuff tied up. And my guess is there will be an honest effort to do that in the next, year or two.
Yeah, well, it seems to me they're about as efficient as the FAA. if you put the BLS in charge of air traffic, we would have estimated airplanes landing at fictitious airports, and we wouldn't know what the heck was going on there. So maybe we should be grateful
Yeah,
that that person wasn't running the FAA.
they're only doing the labor market.
Yeah, they could do a lot less damage there than
In the
managing
air.
metal in the sky.
Yes.
But seriously, this is a big problem because it's just like GDP. GDP includes debt. So it's not really measuring true economic growth. And then GDP is subject to error because the inflation rate really is impossible to actually calculate under our present system.
Yeah. Yeah. Basically, you get nominal GDP, which is how much the economy grew, minus the inflation rate to get the GDP number that they're reporting. So obviously, if you report that inflation is less, that's going to boost GDP growth. And conversely, if inflation is bigger, it subtracts from GDP growth. So the other issue, and a lot of people I don't think understand it, including a lot of people in the business, is that inventories and trade are huge swing factors within that report every month. So in the first part of this year, we saw an enormous amount of companies buy stuff ahead of the tariffs. Well, because that production came from overseas, the Census Bureau subtracted, I think, close to 5%, or maybe it was 4% from GDP because it's gross domestic production. So they subtract imports. In the second quarter, imports dropped significantly and added more than 2% to GDP. And inventories are the same way. A big boost to inventories. Oh, we're going to add that to GDP. And so you had this year, especially, Kerry, these swing factors were huge in terms of these numbers. And there's not much you can do about that. The methodology to me is logical. We're measuring gross domestic product. At the same time, a lot of people don't fully comprehend that. I don't know that the media does a good job of educating people to be aware, especially in this environment that we've been in, that to get the true measure of GDP or growth, look at final sales. To me, that's the number that gives you a better indication of what's happening as opposed to the GDP number.
Hey, well, I have an idea. And instead of celebrating the jobs numbers and the GDP numbers when they're released, how about we don't even bother covering those numbers and we only cover the revisions?
Why not? No, bottom line, this has to be improved. Now, President Trump fired the BLS Commissioner because of these revisions. And he said it was all political. But as I pointed out in my letter, that in August of last year, the BLS announced a big negative revision. Over 800,000 jobs disappeared. And that was about 2 months before the election. So if you're going to play fair is fair, the reality is the BLS did something 2 months before the election that made his economy look a little less strong. So I think the charge that is totally driven by politics and so forth, I don't buy it. The need to increase better data, that's a legitimate criticism and needs to be addressed.
Yeah. Well, here's what the ChatGPT said about that. Ignore the first print, watch the revisions and the benchmark. July's 73K is within the statistical fog. Household employment fell, participation slipped, and the last big benchmark took 818,000 jobs off the books. The birth death plug likely overestimated at the turn. Net, the real job market is flat to slightly negative right now. Stall speed, not expansion. And that brings us to something, I don't want to call it disturbing because truth is truth and truth doesn't care whether you're disturbed or not. But you've got a secular bear market warning out there. You're convinced Most investors are unprepared. Buy and hold will be buy and lose. And in your special report, the theme is the coming secular bear market.
Yeah, basically, what I'm saying is if you look at from the 30,000 foot level, you can see sentiment is wildly bullish. You have rampant speculation. This is hard to believe, Kerry, but 60% of all the options traded on individual stocks in the indices are on the instruments that expire in 24 hours.
That's nuts. You can
It's
only
nuts.
pros can make money that way, and only the people writing them are making money. Why is it
Well,
that
in the short term, obviously,
right?
no, in the short term, that strategy has been working because if you're buying calls on Nvidia and other AI related type stocks and so forth, the tailwind has been pretty strong. My point, though, is that when someone buys a call option 10 to 15% out of the money, the dealer sells them that call. Now the dealer is theoretically short that stock and have to take positions to hedge it. And so, to a certain extent, what's happening with this 60 million shares or 60 million options have been trading a day, and 60% of them are for 24 hours or less. So, in a sense, you have the tail wagging the dog. But
Hmm.
from the bigger picture standpoint, these are all symptoms of a lot of speculation. From a valuation standpoint, Warren Buffett, he has $347 billion in cash. It's almost 30% of his portfolio. Prior to the sell-off in 2000 and 2002, he had about 20%. Before 2007 and 8 and 9, he had about 25%. So his cash position is the highest it's ever been as a percent of his portfolio. And it's not a timing tool, but it's another one of these symptoms, Kerry, that, is the market at a place where you want to be buy and holding long term? And so my point in that special report for those who request it, and the information will be on your website, looks at prior secular bear markets like 1966 to 1982, 2000 to 2009, where the S&P goes through corrections of 30, 40, 50%. And it's stretched over a decade to, in the case of 66, 82, 16 years. So I think we're nearing that point where we're likely to see one of these extended bear markets. And most investors are oblivious to it. Understand that's the way markets work. At tops, everyone knows all the good reasons why the market's in great shape and is just going to keep going on up forever. And that's when you need to pay more attention and be aware that there's danger at your door if you think life is, the market's easy street. We're not there yet. Things like the advanced decline line continue to make higher highs. Historically, that's a good guidepost. In February, I noted that the AD line was not making higher highs relative to the high it had made in November of last year, which suggested we were set up for a pretty good correction. So I'm waiting for things like that to more pinpoint the timing of when I think we're going to see a much more significant correction and it lasting longer. We're not there yet, but it's always better to be prepared and be on the lookout. And that's all I'm trying to do is just say, folks, there are a lot of reasons why caution needs to be exercised at this stage of the game.
There's one indicator that I really like a lot. There's been numerous indicators that predict recessions at every corner, every turn, but occupancy rates in Las Vegas, because Las Vegas, they should call it discretionary income parting, right?
Extravaganza.
Yeah, Lost Vegas, right?
Yeah.
Because you're outside of compulsive gamblers, which are a big problem, let's face it, but
Yep.
but Vegas isn't really built upon compulsive gamblers. I would say they're the profit, and the casual visitors pay the bills. The problem is they're down double digits. Now there
Yeah.
are reasons for it, like it's become a ripoff
Very
extractive
expensive. Yep.
enterprise
Yep.
that doesn't provide value for the money that you're paying, like $30 bottles of water. And, I love it there, but I like the
Yeah.
people watching and the food. I don't, and the shows. But it's become prohibitive to the point where, like the fast food joints are mobbed and the really great restaurants are fairly empty. So the fact that it's declining is really an alarm bell, isn't it?
Well, again, it's if you look at the delinquencies on auto loans and credit cards, they're reaching like 10 and 15-year highs. So one of the themes I've had is that the bifurcation in the economy, you have the bottom 50% of wage earners who have been getting squeezed by inflation. And some of those are the people you're talking about who would maybe in the past take a trip out to Vegas, but they look at the prices and they can't afford to do that. As a counterbalance, though, over the 4th of July weekend, I think you had 3 million people going through TSA checkpoints. Something similar like that is going to happen this, weekend. And so you have this bifurcation, Kerry, with those who have assets like stock portfolios, own their own home. They're feeling a pretty significant wealth effect and have. And that's one of the things that I think is continuing in helping them to continue to keep spending. But if you're a renter and your rent has gone up 40%, but your wages haven't, you're really under the gun. And so there's cracks showing up, and what you're citing in terms of Vegas is one of those cracks. As I said, delinquencies on credit cards, auto loans, they're up 10, 15-year highs. So underneath the surface, there's weakness building. The number of corporate bankruptcies has moved up pretty aggressively this year. So the signs are there. So to me, this plays into what we just talked about in terms of a secular bear market, where what's feeding the beast is asset values. Well, if we see a significant decline in the equity market that lasts more than 2 months, home prices coming down. I wrote a report a couple months ago laying the groundwork of why I think home prices are going to drop 15 to 30% over the next 5 years. So if you see those hits to wealth, then those who have been spending will become much more cautious. And so again, these are the storm clouds out there in the future. In the near term, the market's technically in decent shape. So I'm not saying, oh my God, the sky's about to fall. I'm just saying that right now things are okay, but there are some storm clouds out there that are suggesting that the underpinnings of the economy may not be quite as strong and rosy as a lot of people like to think.
Yeah. And, visitor volume in Vegas, just getting back to that theme, is down 11% year over year in June. And year to date, I think as of July, was down 7.3%. So, this is definitely an issue. Air traffic. The only good thing to come in the air traffic segment now is that you no longer have to take your shoes off when you're going through TSA. I mean, that's a milestone
We'll take any
event
benefit,
here,
right? Versus 25 years ago where, it was very, very much different. So, yeah, not having to take your shoes off, thank you very much.
Yeah.
Especially if you have tie shoes and you're going to try to make a plane.
Pretty soon they won't be confiscating your toothpaste and suntan lotion and my contact lens solution, which costs $20 a bottle, and for 2 bottles. And Denver TSA thought that this was a threat, a global threat to air transport, certainly in America, but perhaps around the world, because it's a liquid, man. I could be mixing it into all sorts of dastardly things, right?
Well, they took one look at you and they said, we better check his bag really carefully. So,
Oh man, like
yeah.
why? This is crazy systems, but it's just indicative of a dysfunctional government that that no longer can accomplish its basic functions, or has great difficulty and expense in even attempting to to do that. So
Yeah.
looking at what we talked about here, Buffett's cash hoard, inflation in the Fed, secular bear market. Hey, gold. Look at gold and silver. Now, we got to talk about silver, copper, potash, just added or will be added shortly to the government's official critical mineral list. This means a boom, in my opinion, for the mining sector because it's an emergency and it's critical now. A lot of the environmental reviews and the legal reviews that would take place ordinarily are going to be basically cost, right?
Well, or expedited, significantly faster than what they have been in the past or would ever have been, obviously, in the last administration. A couple of things I will point out. The chart pattern of gold, for instance, my take has been since we hit that high in April, the markets correct either two ways. Either you get a decent sized decline when a lot of people are bullish, or you get a sideways chop where you just wear people out. And gold has been doing the sideways chop. I think getting above 34.03, which it did today, is the signal that gold is on its way to a new all-time high. So my take has been the last few months, hey, we're going through this correction. When it's over, we're going above 34.96. My guess is 3,600, 3,700. And there's a lot of things coming into it, Kerry. Perception about the Fed. In all likelihood, the Fed will cut the funds rate at the September meeting. Yeah, but, inflation's at about 3%. So that
Stated
is not
inflation.
a good look.
Stated.
President Trump, I'm sorry?
Stated inflation.
Yeah,
The
well,
stated rate.
yeah. So I think those are the things that psychologically feed into, and is a tailwind for gold and silver. And so I think in the near term, to me, my analysis of the gold chart suggests it's about to pop to the upside. We're going to see silver obviously follow, and probably, as it has been doing the last couple months or so, outperform gold to the upside. So near term, I think finally we're getting indications that gold is ready finally to make a move to the upside and to a new all-time high.
$40 silver right now as we speak. Looking at Kitco's ticker, which I don't really appreciate, but for spot 39.02. We just broke 39. That is a huge technical spot. It's bounced back and forth over it, but once we hit 40 is like they better circle the wagons because those short positions there are in real jeopardy, and you can't just at some point you can't just up your price limit.
Well,
say,
you just can't keep getting run over.
you can't keep resetting your options prices.
I'm old enough to remember the spring of 1980 when the Hunt brothers attempted to corner silver. I think it traded up to 50, maybe 51.
50
Okay.
might have it traded
over
over
50
intraday, but I think it closed 50.
Yeah, and then it dropped to $10 very quickly. I mean, they basically screwed the Hunt brothers. There's a story there. We don't need to bother to cover it. But my point is, you get above something like a 40, you have to start beginning to look at, well, that 50 from 40 plus years ago is out there and is a test of that coming. And I would say there's a good shot that it's going to make a run at that $50 mark at some point in time. And maybe it could happen very quickly, given the setup that we have. There's another inflation report that comes out tomorrow. I think the PCE, it's not going to be good news. The next CPI, the PPI report that came out for July was ugly. So again, my point is you have a backdrop that inflation is already at 3%, and the tariffs are going to bleed through and cause more inflation on the good side. The thing that I find interesting is that in his Jackson Hole speech, Chair Powell acknowledged the good side inflation, but didn't reference services. And both the ISM service indicator was up to 69%. Historically, there's a nice correlation between moves in that index and the CPI. So my point, Kerry, is that the inflation news is going to get worse in the near term, and I can't imagine that that won't be a tailwind for the metals.
Okay. And I am in complete agreement with you there. One interesting note going back to the 80s, the last time silver hit 50, it's the only commodity to have not established a new high in over 40 years.
Yeah.
And
Yeah.
that alone makes you think. And then you look at the price action, it's a coiled spring. It's a jack in the box. And when it pops, especially now, the fact that Uncle Sam has said it's a vital, critical mineral or metal, if you will, could just give it the impetus. And I don't think the government's going to nationalize silver mines, but I think they will do exclusive supply contracts with the big producers. There's only a few of them that they have to bother with, and the U.S. and Canada, and those companies can't exactly say no, but what they can do is buy some futures to protect their margins, because the price of silver will, once that gets out, Jim, it's going to explode.
Yeah. Well, and the other thing, the point you made is that silver hasn't made a new high, where probably every other commodity on the planet has in the last 40 years. It starts to attract money. You look at gold and you say, wow, it's made a big move already. And look at silver has and now it looks like it's coming to life. So that alone starts to attract some money for the catch-up trade. And I'm not talking the ketchup that you put on your hot dog.
Yeah, the catch-up trade. Well, we have wars over ketchup, so why not have trades over it? Just looking at it, the Buffett warning. I mean, that kind of says it all. I'm surprised, but I'm not surprised that Buffett isn't buying silver. Last time he tried that little trick, Martin Armstrong exposed him and exposed the system. And, it took 10 years to get over that, even though nobody remembers it now. So metals, you got any feelings about Bitcoin, crypto? I mean, I saw it hit 109,000 the other day, back up to 118 now, which tells me another coiled spring, another potential short squeeze position, because they're gobbling up Bitcoin like they can't get enough, these institutions.
The allocation has been, very, very small. The Trump administration has kind of ordained Bitcoin or legitimize it. And so that is helping as well. What I have observed, though, Kerry, is between the dollar, Bitcoin, and gold, what has often happened is one of the three will be running, while the other two are either going sideways or down. And if we're right that in the near term, the metals are about to have the light shine on them, maybe Bitcoin, it's had a heck of a move. Maybe it goes into a sideways chop for a period of time. In terms of the dollar, I think the dollar is nearing a very important low, but near term, it looks like it's going to go down again and take out the low from a couple months ago. So that will be another tailwind for gold. But if I'm right, because positioning on the dollar is very negative, a lot of shorts, sentiment's very negative. I've seen more articles in the last couple months. Well, maybe the dollar status as a reserve currency will get challenged and so forth. Those to me are all symptoms from a contrary opinion perspective that, all right, it's a little late to be really negative the dollar. It's already down 11% this year. From a price pattern standpoint, I think the dollar will be completing the correction that started after it peaked in October of 2022 at 114.75. So my point is, I think there's a window for the metals to have a pretty good run here. The dollar goes to a lower low. But if I'm right and the dollar makes a fairly significant low, then the metals will probably have a fairly good sized correction. And the rally in gold that I'm talking about, I've been saying we've got a wave 5 rally coming here to new highs. So my point is, if all these pieces fall into place, near term, the metals have a great run. The dollar makes a low over the next 1 to 3 months. And if that unfolds, then that'll bring the backdrop of why there'll be maybe 6 months to 9 months from now, the beginnings of a significant correction in the metals. So, near term, some of these things are coming in. The other thing I'm going to point out is Treasury yields. I believe the long-term trend in Treasury yields is up. And so near term, we might see a little bit more relief. The 10-year might get down to about 407. But after that, I think it's going above 5. A lot of supply continues to come. President Trump has not really narrowed the deficit. And if we see the economy slowing meaningfully at any point in time in the next couple of years, the deficit is going to jump to 3 trillion. That's a lot of paper. At the same time, the Japanese 30-year yield has made a new all-time high. Germany, Great Britain yields are going up. So we're in an environment, Kerry, where these other governments, in Europe especially, they're increasing defense spending from under 2 to 5%. So that the world is going to be competing for investment dollars as governments sell bonds.
Squeezing out.
And typically,
squeeze out.
if you don't have enough demand, you got to raise rates. Rates go up to attract buyers. And I think that's the world we're going to be in over the next handful of years. And so, that's another reason why I think the equity market is going to experience a secular bear market. I believe a secular bear market has already begun in the bond market. Now, when I say secular in the bond market, we're talking 35 plus years. So this isn't something, oh yeah, 3 years from now, it's going to be over. No, 3 years from now will be where it becomes more obvious. And on the 10-year, I think the 10-year goes to 7.5%.
All
and
right.
The reason why is it got over 15.5 in 81, down to 55 basis points in 2020. The 50% retracement of that move is about 7.5. So I'm not even talking about, oh my God, Treasury yields are going to take out their 1981 highs. I'm just saying they're going to retrace 50%. And as you noted, with all the debt that we have out there, anything, a meaningful move like that in Treasury yields is going to be really challenging for both the government and the economy.
All right, Jim, that was exhaustive, and I really appreciate it. Hey, anybody interested, macrotides.com. The link is in the show notes so you can download the latest edition where all of this is discussed and a lot more. If you got a question for Jim, myself, shoot me an email, kl@kerrylutz.com. What do you think? Are we headed for a secular bear market? Are interest rates going higher? Are precious metals prices going higher? Why don't you put it in the Q&A section on YouTube if you're watching it there, or shoot me an email. Let me know your thoughts. Obviously, it's perception, but there's also reality behind that perception. That's what you need to be thinking about. Jim, always a pleasure. Thanks for coming on.
My pleasure as well, Kerry. Stay well.